Hi, my name's Cameron Gleeson. I'm Senior Investment Strategist at Betashares. Today, I'll be answering some of your questions about our geared range of ETFs. New geared ETFs. Thoughts? We've just launched the first funds in our new Wealthbuilder range. So these funds are designed to give you exposure to the share market, but they use gearing in order to, if you like, increase that exposure versus the amount of money you invest in the fund. So the first of the two funds is our G200. This gives you diversified exposure to the largest 200 companies in Australia. The second fund is GHHF, which is a diversified all growth exposure, providing you, in a single trade on the ASX, exposure to both global equities and Australian equities, all in one fund. So both of these funds, as I said, they use a moderate level of gearing with an LVR, or a loan to value ratio, between 30 and 40%. Which means that on a daily basis, you should expect them to participate in approximately 1.5 times the movements up or down in their respective underlying portfolios of stocks. What's the difference between these funds and a margin loan? Unlike a margin loan where you need to submit an application, you might need to go through a credit check, and there's the risk of margin calls, these funds are internally geared. So you just need to buy units on the ASX, they trade on the ASX, and Betashares as the fund manager takes care of that gearing internally. The other great advantage of that is that Betashares is able to access institutional rates of interest in terms of the money borrowed. So you get a really cost-effective access to a geared solution, which is really important if you are looking to gear into the equity market. What are your thoughts about the allocation of this ETF in young Aussie investors' portfolios? For any investor who's using a geared fund, including these funds with their moderate level of gearing, you must firstly be comfortable with a slightly elevated level of risk or volatility versus an ungeared fund. But provided you're comfortable with that, and also provided you believe that in the long term markets will generally go up, these funds, G200 and GHHF, can be a really good solution for a young investor, particularly those with limited capital or looking to participate in equity markets and take advantage of the market's compounding power over time. And sticking to a plan of consistently investing over the long term can really set you up well for creating long-term wealth. What's the difference between G200 and gear? So G200 is designed to be, as we describe, a moderately geared exposure. If we take gear, for example, that is a more highly geared fund with an LVR between 50 and 65%. Now that might not seem like much of a difference, but what that does is it means your exposure to the equity market for gear is far higher. What are the fees for these ETFs? The fees on these funds are 0.35% of gross asset value. If I'm an investor in the fund and I put $100 into that fund, and let's just assume that the fund borrows an extra $50 to invest in the market, it's got $150. The fee is charged on the $150 of assets that the fund's investing. How can investors use these geared funds in their portfolio? So the moderately geared funds, the Wealthbuilder Funds, G200 and GHHF, they're funds that enable you to use more of a long-term investment strategy. They've got a slightly lower level of gearing. Gear and GGUS, while they're funds that can perform very strongly in a bull market, they're funds that perhaps are a bit more hands-on. They're a great way to play a high conviction view. You can allocate less capital to them and get a fantastic amount of exposure to the market. So slightly different use cases in terms of funds. I'd say that maybe gear or GGUS, unless you've got a very high level of risk tolerance, can be a really good trading vehicle versus the G200 and GHHF, more of a buy and hold sort of style of investing.